studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
This slide introduces a common mistake that can create tax problems for shareholders who use a personal vehicle for business purposes. At first glance, the situation may seem reasonable. A shareholder uses a personally owned vehicle to conduct corporate business. The corporation recognizes that business use and pays the shareholder a vehicle allowance. At the same time, the shareholder also attempts to claim the actual vehicle expenses associated with that same business use. These expenses might include fuel, repairs, insurance, maintenance, and vehicle depreciation. Many people look at these two items and think they should both be available. After all, the vehicle was genuinely used for business. The allowance was received, and real expenses were incurred. However, this is where an important tax issue arises. The problem is not that either method is inherently wrong. The problem occurs when both methods are being used to recover the same business use costs. This is often referred to as double dipping. Let's look at the sequence shown in the center of the slide. The vehicle is used for business. The shareholder receives an allowance. Then the shareholder also claims vehicle expenses relating to that same business use. At this point, we must ask the critical question: can both be claimed? The concern from the CRA's perspective is that the shareholder may be receiving compensation twice for the same underlying costs. The allowance is intended to compensate for business use of the vehicle. The expense claim is also intended to recover vehicle-related costs. If both are used to recover the same costs, there is a risk that the taxpayer is effectively receiving duplicate tax benefits. This is why the issue becomes important. Tax rules generally attempt to provide fair compensation for legitimate business use. They are not designed to allow the same expense to be recovered multiple times through different mechanisms. As a result, whenever both an allowance and expense claims appear in the same situation, additional analysis is required. Tax advisors immediately ask questions such as: what type of allowance was paid? What expenses are being claimed? Do the claims relate to the same business use kilometers? And are the taxpayer's records sufficient to support the treatment being used? The key lesson from this slide is not that allowances are bad, nor is it that vehicle expense deductions are inappropriate. Both can be perfectly legitimate when used correctly. The issue arises when the same business use costs are effectively being claimed twice. That is the tax trap being illustrated here. As we will see in the next slides, understanding why the CRA objects to this type of double recovery helps clarify the proper approach and shows how taxpayers can avoid creating unnecessary tax problems. The key takeaway is simple. Receiving a vehicle allowance and claiming the same vehicle expenses for the same business use may create a tax issue because the taxpayer may be attempting to recover the same costs more than once. Understanding that risk is the first step toward applying the correct vehicle compensation method. Now let's examine why the CRA objects when taxpayers attempt to combine a vehicle allowance and an expense deduction for the same business use cost. To understand the CRA's position, we need to look at the purpose of each method. On the left side of the slide, we have the allowance method. Under this approach, the shareholder tracks business kilometers driven. The CRA mileage rate is then applied to those kilometers. The resulting allowance is intended to compensate the shareholder for the costs of operating the vehicle for business purposes. In other words, the allowance is not arbitrary. It is specifically designed to help cover vehicle-related costs such as fuel, maintenance, repairs, insurance, depreciation, and other operating expenses associated with business driving. Now let's look at the expense method shown on the right side of the slide. Under this approach, The shareholder incurs actual vehicle expenses. Those expenses are tracked and documented. The business use portion is calculated, and eligible amounts are claimed or reimbursed based on the actual costs incurred. Notice that both methods are addressing the same underlying costs. The allowance method compensates for vehicle expenses using a standardized mileage rate. The expense method compensates for vehicle expenses using actual costs. The objective is similar in both cases. Both methods are designed to recover business use vehicle costs. This is why the large warning symbol in the center of the slide is so important. The problem arises when both methods are applied to the same costs. Consider the example shown at the bottom. Suppose a corporation pays a $1,000 vehicle allowance. The shareholder then turns around and claims $1,000 of actual vehicle expenses relating to the same business use kilometers. From the CRA's perspective, the same underlying costs may have been recovered twice. The allowance already provided compensation for business use. The expense claim is attempting to recover those same costs again. That is what creates the duplicate benefit. The CRA's concern is not about preventing fair compensation. In fact, fair compensation is one of the CRA's goals. If a shareholder uses a personal vehicle for business purposes, it is reasonable for them to be compensated. The concern arises only when the same costs are compensated multiple times. That is why the CRA distinguishes between fair recovery of expenses and duplicate recovery of expenses. The tax system is designed to allow reasonable compensation for legitimate business use. It is not designed to provide multiple tax benefits for the same underlying expenditure. This principle appears repeatedly throughout the Income Tax Act and is especially important when dealing with vehicle-related claims. The key takeaway from this slide is straightforward. The allowance method and the expense method both address business use vehicle costs. Because they are both designed to compensate for the same costs, the CRA generally does not allow taxpayers to recover those costs twice. Understanding this principle helps explain why careful planning and proper method selection are essential when compensating shareholders for the business use of a personally owned vehicle. This slide summarizes the practical rule that every owner-manager should remember when dealing with vehicle compensation. The principle is actually quite simple. Choose one reasonable method and apply it properly. As we've discussed, there are two common methods available. The first is the CRA mileage allowance method. The second is the actual expense or expense reimbursement method. Both methods can be appropriate. The important point is that they should not both be used to recover the same business use vehicle costs. Let's begin with the mileage allowance method shown on the left side of the slide. Under this approach, the shareholder keeps an accurate mileage log throughout the year. Every business trip is recorded. Once the total business kilometers have been calculated, the CRA-approved mileage rate is applied. The corporation then pays the shareholder a reasonable mileage allowance based on those business kilometers. Once that allowance has compensated the shareholder for the business use of the vehicle, those same vehicle expenses should not be claimed again through another method. The mileage allowance is intended to cover those costs. Now let's look at the expense reimbursement method on the right. Instead of tracking only kilometers, the shareholder keeps records of actual vehicle expenses, fuel receipts, insurance costs, maintenance invoices, repair bills, and other eligible vehicle expenses. The shareholder then determines what portion of those costs relates to business use. Only that business use portion is reimbursed or deducted. If this method is chosen, the shareholder should not also receive a mileage allowance covering the same business use. Again, the objective is to avoid recovering the same costs twice. The decision tree shown in the middle of the slide illustrates the recommended approach. Start with the business use of the vehicle. Choose a compensation method. Then follow that method consistently. Whether you choose the mileage allowance or the actual expense method, consistency is important. Changing methods without proper analysis or attempting to combine both methods for the same business use can create unnecessary tax issues. Notice the large warning at the bottom of the slide. Not both for the same business use. This is the key rule that prevents double dipping. The professional tip reinforces another important lesson. Regardless of which method you select, maintain detailed records. If you choose the mileage allowance method, keep an accurate mileage log. If you choose the expense method, retain receipts and documentation supporting each expense and the business use allocation. Strong documentation is one of the best ways to support your tax position during a CRA review. Ultimately, the choice between methods often depends on the specific facts and circumstances. One method is not universally better than the other. The important point is that whichever method is selected should be reasonable, properly documented, and applied consistently. The key takeaway from this slide is simple. Select one reasonable method, either the CRA mileage allowance or the actual expense method. Apply it consistently. Maintain good records. And avoid claiming the same business use vehicle costs twice. Following that approach helps ensure proper tax compliance while reducing the risk of CRA challenges.